Hello and welcome, everyone. Thank you for joining us in another live. As you know, April is the Financial Literacy Month, and we at Curaçao wanted to share with you some valuable information for you to have the knowledge and power to use all this finance information to your benefit. So today we have a very special guest. Is Jorge Diaz, which is an expert in everything that it comes to mortgages and home loans. And today he's going to be helping us walk you through some basic concepts for you to understand how all of this work. So thank you, Jorge, for joining us and welcome.
Thank you for the opportunity, and we're here to help our community.
Thank you so much, Jorge. So let's start talking about what is a mortgage. This is a term that we all need to understand. What is basically a mortgage?
A mortgage is a loan secured by the property. So basically, the property will respond for anything on your mortgage.
Got it. So we're basically getting a loan to buy a house, but the house itself supports that loan. So if I don't pay, the house is there obviously to back up that loan.
Right, exactly. It will cover the loan and make sure that the property is in value what you're purchasing for.
Great, great. How many type of home loans are available to borrowers?
Programs, there's many, but basically there's two types, which is the FHA, the government insured loan, and the conventional loan, which is insured by private banks.
Excellent, excellent. And how can a borrower be eligible to qualify for a home loan? What do they need? What the requirements that they will need to get in
So
order?
basically, your credit, which is a history of payments, and then you qualify with your income. Make sure your ratios are within 45% or less, including the house and any other payments that you may have.
So that ratio, can you expand a little bit more? So basically, the ratio is all the money that in the household the family makes. There's a percentage that has to be available to cover that payment for that loan.
Yeah, basically, we'll use a gross income for everybody who's going to be in the loan and make sure there's different programs, but basically, it's 45% or less that will cover the house, any car payments, any credit cards. They cannot be over 45%.
Got it. Got it. And so banks and financial institution or other lenders, what are the major factors that they review when deciding how much money to give you? Like, how can I get a loan for a bigger house or that is more expensive than a small one? What are those factors that they review?
Basically, if it's going to be your primary house, you're going to be living on it. That's the first thing they see. Second of all, that the house has a value, what you're purchasing for, and then your income to make sure. Interest rate is based on if it's going to be your primary house or your second home, or if it's going to be an investment. That determines the criteria to qualify you for the loan.
Great, great. Let's talk about now, Jorge, about there's a term that I always hear on the type of loans. There's some that are fixed rate and others adjustable rate. What did that mean?
Fixed rate means going to be the same payment for the duration of the loan, which is basically 30 years. And then there's the adjustable, which starts with a lower payment and adjusts every year until it becomes to the regular rate. So those are the ones used for investors or people who's barely starting on their job and they know they're going to get an increase. So they want to start low so that way, they can afford the payments.
Got it. Now, I have also heard about other term mortgage insurance. Uh, when it is required.
Mortgage insurance is required on every loan over 80% of the value. So basically, it's every loan on purchase. What happens is in case you default, the insurance company will cover the bank. So you also have to qualify for them.
Great. What about down payments? So a lot of families might not have large down payments, to purchase their houses. What are the advantages and the disadvantages of having a large or a smaller down payment?
Basically, the FHA, which is the government insured loan, is the one that has the minimal down payment, which is 3.5. Okay. Then there's the conventional, which is by private banks, which is 5%, sometimes 3%, but the criteria is hard on that one. But there's also down payment assistance programs that can help you with your down payment and closing costs. So the long as you qualify for the payment, you can buy a house.
That is so interesting. So there's actually programs to help families that don't have large down payments to make that dream come true.
Yeah, basically, when you buy the house, the hardest part is gather money for the down payment because people, it's hard for them to save. But these programs will give you the down payment and you make your payments.
Great, great. So I know, Jorge, that you've been in this industry for a long, long time, and you have a lot of experience helping a lot of families getting their loans for their houses. What are the biggest or more common mistakes that you see families make, and how can they avoid them?
The biggest mistake is the credit. If you don't have credit, you got to establish credit. And you guys are great for that. Your credit cards, your loans are helping people start building their credit. The other issue is the down payment. Like I say, most of the people, they keep it on cash, and that's a problem. It has to be in a bank for at least 60 to 90 days in order for them to use it for your down payment. So those are the two biggest things when you're purchasing a house.
Thank you, Jorge. So that was all the questions that we have for today. We really wanted all of our viewers to just understand basic concepts about how mortgages work. We really thank you, Jorge, for being here with us today and answering all those questions. So thank you so much.
No, thank you for the opportunity. And don't forget, people, get your credit with Curaçao. That's the way to start. Thank you.
Thank you so much, Jorge. We appreciate your help, and we wish you success in the future with all your career and helping all those families. And to all of you, thank you for joining us one more time during the month of the financial literacy. We wanted you to have all this information for you to make the right decisions for you and your family. Thank you once again.
Thank you.